This is a second in a two-part video of the statement of cash flows. This is going to use the same sample problem to solve the statement of cash flows, but this time we're going to look at solving operating using the direct method. You will end up with the same number. So it's only the operating section where you have a choice. Investing and financing are both presented direct. And you do have a choice. While FASB strongly encourages using the direct method, with a reconciliation using indirect, most companies do use the indirect simply because it's easier and they only have to do it once. If you use the direct method, you have to do it again using the indirect somewhere in your disclosures. But if you use the indirect, you're done. Government accounting does require the direct method, so it's only FASB rules, not the GASB rules, where you get a choice. So looking at a comparison, now remember we're only talking operating. Investing and financing is both the direct method. With the indirect method, we start with an accrual number, net income. We add back non-cash expenses, subtract any gains, add any losses. If an asset changes, you do the opposite. If a liability changes, you do the same. But what about the direct? Well, instead of starting at the bottom, you're starting at the top. You start with revenue, cash received from customers, cash paid to vendors. So it's presented in a direct manner. Cash received, cash paid. The same number, the bottom number will be the same. Net cash flows provided or used in operating. It's just how you present the information, indirectly or directly. Another key difference is using the indirect method. You have to add back in those non-cash items, add or subtract them, adjust for those. But with the direct method, you're not starting with net income, so they're not in there to remove. You can ignore them. Indirect, you start with net income. You start at the bottom of the income statement to get to the change in cash. With the direct method, you start at the top of the income statement. You start with revenue, and you're looking for cash inflows and cash outflows presented directly, as opposed to simple indirect reconciliation from net income to cash. And this will make more sense when we go through it. Cash receipts, cash disbursements. It's calculated the same way as investing. And what do we mean by that? Create T accounts. Recreate what happened to current assets and current liabilities as they relate to the expenses reported on the income statement. That's the direct method. You're looking for a direct relationship between income statement accounts and the balance sheet accounts. So you're still going to need an income statement. You're still going to need a comparative balance sheet to do this. Okay, for cash receipts, you want to think revenue. What affects revenue on both sides of the balance sheet? On the asset side, it's going to be accounts receivable because revenue was recorded but no cash was received. It's an accrual. Liabilities, we're going to be looking for unearned revenue because revenue was not recorded but cash was received. Remember what unearned revenue is. I was paid but I haven't done the work yet. What about cash disbursements? Well, think about your expenses. What affects expenses on both sides of the balance sheet? On the asset side, we're going to be looking at prepaids and inventory. Liability sides, we're going to be looking at accounts payable and any other payables. Okay, so now let's get started. This was that same example we looked at the other video when we looked at the full statement of cash flows examples. We have a comparative balance sheet and we have an income statement. What do we need? Remember, we're looking for a direct relationship between these two statements. And where do we start? Remember, with the indirect method, we start at the bottom. We start with net income. But with the direct method, we start at the top. And your supplemental information, investing and financing portions. Okay, sales. What's the direct relationship? Accounts receivable. Cost of goods sold, what's the direct relationship? It's going to be two. It's going to be merchandise inventory and accounts payable, because that change, how we're going to recreate this, you'll see in a moment. Now, do we need gross profit? No, we don't. We don't need operating expenses. We don't need depreciation expense. We needed it with the indirect. We do not need it with the direct. It's a non-cash expense. We can ignore it. The next line item is other expenses. What's the direct relationship on the balance sheet? That's going to be your prepaids. Okay, so using the direct method, here's what I need. Plug your beginning and your ending numbers. You had total sales, increases accounts receivable, increases revenue. Plug it in your T accounts. Put in your ending accounts receivable number. What's the difference? Solve. What is that 574,170? How does accounts receivable decrease? It means my customers paid me. There's your cash. Total revenues. Accounts receivable increased. That's going to be my accounts receivable increase is going to be the net cash receipts from customers. So I can take the total revenue, subtract the increase in accounts receivable to get net cash received from customers. Okay, now let's look at the next item. Cost of goods sold has a direct relationship with accounts payable and inventory. Say plug your beginning numbers. And remember that cost of goods sold will decrease inventory. Here's your ending number. Okay, and I'm not done yet. Solve for inventory first, because if I purchase inventory for $310, the majority of companies are going to put that on accounts payable to take advantage of good cash management practices. Now solve for accounts payable. That's cash paid to suppliers. That $366,620, I needed to solve inventory and accounts payable to determine what the cash is. So net cash received, net cash paid. Now let's look at other expenses. Plug your beginning, plug your ending. The difference is $350. That's going to be your decrease. Your decrease in prepaid expenses, net cash paid for other expenses. This is how you solve using the direct method. You look for a direct relationship between the income statement accounts and the balance sheet accounts. Current assets, current liabilities. So here is just the numbers that you solved for. But how is it going to look on the statement of cash flows? The top, the indirect method, this was that reconciliation of net income to cash from that first video. Look at the bottom, using the direct method, cash received from customers, cash paid to suppliers, cash paid for operating expenses, cash paid for income tax expense. That was on the income statement, and there was not an income tax payable on the balance sheet, which means you had to have paid it. End up with net cash provided from operating. It's the same number. Indirect or direct, it's just presentation. Okay, now let's look at the statement of cash flows. This was the other way, showing the indirect method. Now let's change it, showing the direct method. You end up with the same numbers. It's just presentation. You can choose to use the direct method or the indirect method for the statement of cash flows. You're required to use the direct method for investing and financing.